Joining me now with more is Simeon Wallace. He's a CIO at Aprio. Simeon, thanks so much for joining us down there in Atlanta this morning. Can this market momentum continue?
We believe it can. We have the Fed announcement coming up next week. We think the market will be excited listening for how they're looking at 2026. And we believe that with strong earnings growth expected next year, that the market can march higher over time.
What else are you watching in terms of what will guide the direction forward?
The main investment controversy right now is the spending on AI through the economy, led by the hyperscalers and the Mag 7 and their capital expenditure plans. So long as they keep spending, or it looks like it's going to march higher, we think the overall market will continue to march forward. But if we do see a pullback there, then there could be some concern over future growth.
December certainly does have seasonals at play here, the third strongest month of the year, typically a Santa Claus rally, as they call it on Wall Street, to end as well. Anything other than this rate cut that you think could buoy markets as we look to round out 2025?
We believe that that's really the focus right now is on the rate cuts, and then really what happens at the press conference afterwards in terms of what the Fed is signaling about how they're thinking about any sort of reigniting of inflation versus potentially weakness on the job front. So it's really what we feel like is a Fed-focused market right now.
Fed-focused market will get the decision next Wednesday, December 10th. Market's certainly pricing in a 0.25 percentage point rate cut. How does that set things up for your 2026 outlook?
We believe that the Fed's going to continue down this path, but they're going to do it in a very gradual way. Our expectations is that we'll see likely 25 basis points in the first quarter, 25 basis points in the second quarter, and then the Fed will pause and think about what the economy looks like as we move towards the back half of 2026. We are pretty excited about 2026, though, on the economic front, which would have us believe that those two rate cuts are probably where the Fed will end up as we go through the year.
Two rate cuts as we work our way through the year. In terms of portfolio positioning, how should people be thinking about their allocations?
We are seeing mid-cap and small-cap companies. We're starting to see their earnings as we look out into the future really pick up again and accelerate. With rates coming down and earnings in small and mid-cap companies starting to pick up, especially relative to large-cap companies, we see a broadening out overall of the market in terms of what's likely to perform well. We also believe with the Fed lowering rates, we could continue to see that weaker dollar, which should help with international stocks, specifically emerging markets. So some of these trends that have started towards the latter half of this year really look like they're continuing to 2026.
What kind of tailwind can stimulus provide, both fiscal and monetary, as we work our way through 2026?
So the Fed is the monetary stimulus that we just talked about. The fiscal stimulus goes back to some of the bills that have been passed this year in Congress, specifically the One Big Beautiful Bill. And what we're going to see there is we'll see consumers end up with a little bit more money in their pockets as we have tax cuts come in the early part of the year, while companies should benefit from tax changes that relates to capital expenditures, which should play out throughout the year. And so we'll have these two nice supports on the fiscal side, with monetary stimulus as well. And then the third component here, which is idiosyncratic to really 2026, is that we have the 250th anniversary of the U.S. We have the World Cup coming here. We believe that means that we'll have foreign travel come spend money here in the U.S., as well as people feeling a little bit more patriotic and spending more money here too. So a lot of tailwinds as we move into the year.
I do want to ask you about the jobs market, Simeon, because we had seen, in fact, that some of those rate expectations had strengthened or solidified, if you will, after what was a disappointing private sector jobs report from ADP yesterday, showing that 32,000 jobs were lost in the private sector versus an expectation of a gain of 40,000. Plus, we had delayed non-farm payroll reports that do include the federal numbers, of course, when the government was shut down. How does that jobs landscape factor into your thesis?
The jobs landscape is somewhat mixed signals we're receiving, because on one hand, we do get the ADP numbers, but then we have initial unemployment claims, which have been running very low overall. And so we believe that companies are still being very thoughtful and deliberate about their hiring plans. But at the same time, for the most part, you're not looking to really shed jobs right now. And so it's more of a stasis than any specific direction when it comes to the employment picture. But the Fed is concerned about that we might continue to see additional layoffs, or see those at least escalate as we move through 2026.
What does that mean for inflation? Of course, we know the Fed does have a dual mandate, maximum employment and contained inflation.
We believe the Fed's view of inflation is to be cautious. They don't want to necessarily move very aggressively to lower rates because they are understanding that inflation at times has picked up, especially services inflation, where that has not moved down as much as goods inflation. Coming into this year and throughout the year, the Fed has been more concerned about goods as we had tariffs come into play and see how that might impact goods prices. More recently, those have started to decline again, been a little bit more deflationary. But the services side of inflation is where we are spending our time focused on, because that's just been stickier than what we would have liked.
Yeah. Simeon Wallace, CIO at APRO, joining us this morning from Atlanta. Simeon, thank you.
Thank you.